Welcome to Trading Day. I'm Lindsay Biscaya. Let's get to some of the stories we're following in the BNN Bloomberg newsroom. Canadian retail sales rose in March, but surging gasoline prices appear to be increasingly eating into household budgets. Retail sales rose 0.9%, and StatsCan is estimating sales rose another 0.6% in April. In March, sales were up in 4 of 9 sectors, led by a sharp increase at gas stations and fuel vendors. Tenaris is investing in Ontario. The global manufacturer of steel pipe products will invest $306 million in the province to modernize and expand its operations in Sault Ste. Marie. The move is expected to create up to 200 new jobs, as well as generate broad economic benefits across Ontario's steel sector. And we're watching shares of CAE today, which are down in trading. That's after the flight simulator reported profit in its most recent quarter that fell compared to the year before. The Montreal-based company also unveiled a plan to increase operating income by 30% or more by 2030, targeting as much as $1 billion. CAE says the strategy will include a greater focus on defense clients. And we're watching the TSX closely today. It is jumping to the highest mark since early March, driven in particular by a run-up in financials and tech. You can see it's up at around 34,500 points right now, 0.3% for the day. We'll continue to watch that. Also watching U.S. markets, all in the green as well. The Dow Jones up by 0.8%. The S&P 500 also seeing some pretty remarkable runs this week. And as you just saw, markets, they are trading at a record high today, driven by financials and tech. So joining us to discuss that and more is Michael Zinn, Managing Director and Senior Portfolio Manager at UBS. It's great to have you join us. Good afternoon.
Great to be with you, Lindsay.
Let's talk about the TSX first of all, and the highs we're seeing today. Maybe if you can go into more detail into what's driving the TSX up.
Yeah, I mean, this is a real tale of two countries as far as at least financials are concerned. I mean, the TSX much more dominated than the U.S. in financials. I think it's about 34%, and it's really a story of rate cut winners. You know, I mean, the Canadian Central Bank was much more aggressive in lowering rates, had a lot more success in lowering rates, combating inflation, and you're really seeing that as a tailwind for the financials in the Canadian index. So they've had a lot of strength really since that cycle began in 2024. You know, as we look forward, the question is, you know, are valuations demanding, and are we looking at a rate hiking cycle in Canada? And of course, those can sometimes be headwinds for the banks, but that's really what's been driving the higher highs in the TSX. And it's in stark contrast to what we're seeing in the U.S. as far as financials, where the rate cutting cycle has really had trouble getting going, and banks have been real laggards in the U.S. as a consequence.
That's a good segue, because I did want to bring in U.S. markets after that first question. But I do want to talk about the S&P 500 too, though, because it's set for its longest weekly rally since 2023. So maybe a stark contrast in some ways. But what do you make of that rally and what else we're seeing in U.S. markets?
Yeah, I mean, you know, like the tech part of the Canadian side, tech obviously has been the driver of returns here in the U.S., just massive performance, particularly by the chip sector, massive upward revision, particularly in the chip sector and also in the energy sector. And so there has been in the aggregate, huge upward earnings revisions, but it's been pretty narrowly concentrated in those two sectors, the chip infrastructure sector and the energy sector. So we're not really getting broad participation in the rally. It's sort of narrow. And it's not unusual for the summer months to have some sideways action. And you know, we should also be cognizant of here in the U.S., because of inflation concerns, deficit concerns, real yields have been rising. When real yields get high, they become more and more of a competitive factor versus equities. So that could be a near-term headwind as well. Our basic thoughts about our risk-on posture here in the U.S. is to stay long tech, stay long chips and memory, and we're seeing the chip software design companies today really surging. But as a hedge, to have a little bit of the aggregate software index in the portfolio, bit of energy in the portfolio as well, of course, in the event that the events in the Middle East continue to linger. So having a little bit of balance between tech and some of the counter tech kind of pieces, we think makes a lot of sense.
I did want to ask you about the events in the Middle East as well. And when you say you think people should have maybe a little bit of energy in their portfolio, what types and what markets are you looking at in terms of energy?
Yeah, I mean, we would probably have broad energy exposure. I would probably have the least amount of exposure to the actual drillers because we don't really know what the direction of price is going to be. If we get relief in the Middle East, we could see a sudden drop in oil price, and if we continue to see it linger, we may see the prices hover around here. What we are seeing a lot of profit area is in the refiners, of course. Crack spreads are super high, so the refiners are doing very well. The integrated oil suppliers, of course, are doing very well as well. So, tech is a massive part of the S&P. Energy is a tiny part of the S&P. So to have a little bit of an overweight in energy still might just mean 6% of your portfolio or so might be in energy. So we think that's a relatively easy decision for those white knuckle days where the headlines in the Middle East are not as benign. Things might be escalating, and we think it's a natural hedge. And those companies in their own right should probably continue to do well for the foreseeable future.
Got it. I wanted to ask you about the Mag 7 performance of late. Obviously, we saw NVIDIA report earnings earlier this week. What are your thoughts on the situation the Mag 7 are in this moment? And do you think it's justified in terms of all the valuations we're seeing?
Yeah, I do think it's generally justified. There is a tremendous amount of CapEx. People are beginning to question, can their balance sheets sustain it? There used to be days of massive free cash flow. For the foreseeable future, that cash flow is going to be a lot less as this CapEx, continues to be pretty monumental. But we do think the return on investment on all that CapEx is going to be really substantial. So I think that most of those players, particularly the ones who have a cloud offering, who have a chip offering, who have a model offering, are going to be really in great shape. And what we saw from some of the reports from some of the chip giants earlier this week is, that demand is just through the absolute roof. I mean, just absolutely, monumental amounts of revenue being forecasted in the guidance by some of these companies. So, until the CapEx cycle really begins to decelerate, we think that the supply-demand balance is still very favorable for those platform players. And as these private companies come to the fore, and we see their financial disclosures and how much of the computer demand they're gobbling up, that should also strengthen the hand of the Mag 7 players. And it may be by comparison, some of these private companies may not look as robust from a financial standpoint. They're still running massive amounts of losses on relatively small revenue. Everyone is expecting them to have super large growth, and that's what's justifying the very large valuations. But I think by comparison, when you look balance sheet to balance sheet, cash flow statement to cash flow statement, Mag 7 may have a pretty nice comparison relative to the newly emerging private going to public players.
Okay, we'll leave it there. Michael Zinn, Managing Director and Senior Portfolio Manager at UBS. Appreciate your time today. Thanks so much.
Thanks so much.
Canada's retail sector saw a solid rise as higher gas prices lifted spending. We will break down Stats Canada's latest report right after this. Stay with us. Canadian retail sales rose 0.9% in March to $72.7 billion, helped primarily by a sharp jump in gas sales as prices spiked following Middle East supply disruptions. However, core retail sales, which excludes categories like gas and auto sales, actually fell 0.1%. So joining us now to break down what this means for the Canadian economy is Robert Kavcic, Senior Economist and Director of Economics at BMO. It's great to have you join us.
Sure thing. Thanks for having me.
What is your read on the numbers we're seeing today? Like, how much of the gain is really just gas prices rather than improving consumer demand?
Well, pretty much all of it. That's the short answer. When you have a spike in pump prices like you did in the month, that directly flows into retail spending, not because consumers want to pay more. It's just that's the amount of money flowing out of their pocket, right? So that gets captured in the retail numbers. And we and analysts, the Bank of Canada, are immediately going to scrub that out and look past it and say, okay, what are spending trends across other categories? Quite a bit flatter. More importantly, what is spending doing in volume terms? How much physical stuff are Canadian buying? And that was down again in the month. And if you look back over the last 6 months, the last 12 months, the volume of consumer spending in Canada has been pretty sluggish overall.
Can you dive into that deeper, both the spending and other categories that you say was pretty flat, and all your other findings that you were looking into in terms of just how much Canadians are spending and where?
Right. So you get quite a bit of upward spending pressure in areas like groceries and gas, and that's mostly driven by inflation, right? Discretionary spending, whether it be autos, which have come back relatively well, or other categories, whether it's general merchandise, sporting goods, consumer electronics, things like that, the volume trends have been quite a bit flatter. And reason being here is that Canadians are kind of faced with this pressure where a lot of the essentials or the non-discretionary items are taking a bigger share of their wallet, whether it's, going to the grocery store to buy food that's rising 5, 6, 8% per year in price. Or even things like mortgage payments, which are resetting higher at a steady rate right now. That's, taking discretionary dollars out of the Canadian wallet and as a result, a little bit less spending elsewhere.
How concerning is that for real economic growth?
Well, it's a headwind for sure, and it's a headwind that's probably going to be persistent for 2026. So you can look at the issue with gas prices. Maybe it's temporary. It's turning out to be a lot less temporary than a lot of us had hoped, 2 or 3 months ago. The longer that persists, especially into the summer, the more and more that's going to kind of hold back those discretionary items. That could very well go away really quickly, though, right? Like as sure as we're sitting here, we could see, a deal between the U.S., Iran, and a very sudden reversal in gas prices, which would help and take some stress off. The other side of it, on the mortgage side, we're going into the middle of the year, and we're going to have probably, more than 1.2 million mortgages renewing in Canada this year, and the peak of those renewals is going to be coming around the middle of the year. And keeping in mind, a lot of Canadian households are coming off of 1.5%, 2% mortgage rates, rolling into rates that are more like 3.75% or 4%. They're going to make those payments every month, but they're going to do so at the expense of some other discretionary items. And that's a headwind that we know almost for sure is not going away in the next 6 to 12 months or so.
Mm-hmm. How does all of this fit into the Bank of Canada's decision making right now moving forward?
Well, so there's some push and some pull on the Canadian outlook, right? So we're getting quite a bit of fiscal stimulus. The flip side is that areas like housing and consumer spending specifically are still relatively slow. And from the Bank of Canada's perspective, this kind of just reiterates that we're in an environment where growth is running, probably 1.5% or so in the first quarter, generally below potential overall. And for the Bank of Canada, I mean, this just reinforces that they should be pretty comfortable on hold here with rates at, the low end of what they would consider neutral. There's pricing in the market for, upwards of 50 basis points of rate hikes later this year. Given the macro fundamentals, given what we're seeing with growth, given what we saw in inflation earlier this week, which was pretty cool. We just don't see the case for rate hikes in the near future at all, to be honest.
Does it depend, though, and I know you've talked about this a lot over this conversation, is just how long this conflict in the Middle East continues on, like how long we're seeing elevated gas prices, for example. Would that maybe change your view heading forward or in the early months of 2027?
Yeah, it's something the Bank of Canada is being especially cautious about too, right? Especially coming out of a period where we had a number of years of well above target inflation. They don't want to allow inflation expectations to get reinforced again. And look, persistently high gas prices is an easy way to do that because pretty much every Canadian sees those prices every day on the way to work, right? So the bank will guard against that. The good news for the bank, though, is that outside of gas prices, we've actually seen pretty impressive progress on inflation to the downside, and especially on core inflation over the last 3 and 6 months. So they have that working in their favor. And maybe contrast that to the Federal Reserve, where yes, we're seeing the same gas price shock, but underlying core inflation fundamentals are actually moving the other way. They're actually accelerating a little bit. So yes, the longer it lasts, the more likely it is the bank gets more concerned about it. But given everything we see on the ground right now, we just think the bar is pretty high for them to actually go ahead and raise rates.
Okay, we'll leave it there. Robert Kavcic, Senior Economist and Director of Economics at BMO. Appreciate your time and your insight. Thanks for joining us.
Sure thing. Thank you.
Coming up next, the CRTC is formalizing new rules that will force streaming giants to invest more in Canadian content. It's a move that could escalate trade tensions with the United States, of course. We'll break that down right after this. The CRTC has unveiled a major new framework for online streaming services that will require companies like Netflix, Disney, and Spotify to devote more of their Canadian revenue to supporting domestic and Indigenous content. So joining us now to break down the implications of the new framework is Douglas Barrett, adjunct professor at York University's Schulich School of Business. It's great to have you join us. Thanks so much.
Thank you. Thanks for having me on.
Yeah, this is a very interesting conversation. I mean, to you, what's the biggest takeaway from this new CRTC decision?
Well, interesting question. Since we're in the middle of Stanley Cup season, I would say that we're at the end of the second period. The outcome is uncertain, and we don't know whether this will get wrapped up in the third period or whether there'll be multiple overtime periods. The big takeaway, I think, is this is a step in a multi-step process, but the ultimate conclusion of what it will all mean, it remains highly in doubt for a number of reasons, which I can discuss.
Yeah, let's get to some of those reasons then. I mean, what are some of those reasons? Let's start there.
Well, I think to start with, it must be understood that the CRTC is operating under the Online Streaming Act, which was passed at the end of the Trudeau era in 2023 by the Parliament of Canada. So the CRTC is an independent regulatory authority. It has its own rules and regulations, and it is theoretically independent of direct government oversight on specific decisions. And the Online Streaming Act gave the CRTC its marching orders as to what to achieve. And the principal thing that the Online Streaming Act asked the CRTC to do was to create a situation in which the online streamers made a meaningful contribution to the Canadian broadcasting system and had a contribution, a meaningful and appropriate contribution in terms of developing and producing and paying for Canadian content. And that's what this decision sets out to do, which is to kind of initially make sure that the foreign streamers make a contribution to the system, and in a sense to rebalance the existing obligations of Canadian broadcasters along the way. So this is a kind of a shot at leveling the playing field between the foreign streamers and the Canadian broadcasters and ensuring that each makes an appropriate contribution to the system.
Is going from 5% to 15% enough to level the playing field in your eyes?
Well, I think that the idea that there's been some headlines about the CRTC tripling the obligation. The CRTC made it clear when it put out its initial decision that the 5% number was a, quote, base contribution, and it wanted to get that out the door, but that it would be coming back with a kind of a final decision that sort of set out the main parameters and standards. And that's what this is. This is not a tripling of an original decision. This is the Part B and a publicized Part B of what the Commission started with its original 5% decision.
One of the decisions also that the CRTC made was that the contribution no longer needs to fund programs of national interest, aka PNI. What would the impact of that be on the Canadian production of like Canadian dramas, documentaries, feature films?
I'm going to say nobody knows yet, not just me. I've been speaking to a few folks today, and everybody's working through the implications. The commission has developed a new language around what it expects streamers and broadcasters to do. And so it's set out new terms, new definitions. It's replaced the PNI obligations with something else, and it remains to be seen whether that will continue to have a meaningful kind of contribution or make a meaningful contribution as it has done in the past. So it's not that it has stepped away from the plate, as it were, another sports metaphor. It's that it is kind of taking a swing at a new pitch.
The U.S. Motion Pictures Association says the rules are discriminatory and could violate the USMCA. How serious is the trade risk in all of this and the upcoming negotiations we have this summer for CUSMA?
Well, I think it's fair to say it's pretty serious. I think there's somehow an assumption that the government can go to the table with the Americans and the government of Mexico and do whatever it wants to do. But as I pointed out at the outset, the CRTC is operating on an act of parliament that has to be withdrawn if the commission or if the trade folks want to negotiate out from under this process. This is a process that's been going on since before 2020, and everybody is kind of doing their job in an orderly way. For instance, the Motion Picture Association immediately appealed the 5% base contribution decision. The hearings were held in June of 2025. We've waited almost a year for a decision from the federal court as to whether that it will support the legality of the CRTC's initial decision. So needless to say, nothing's been paid under that original 5% decision, or nothing's actually been received and put into programming. And in addition, there's absolutely no doubt that the Americans will appeal this decision, as well as bringing the issues that it can to the table. And I've referred to this in previous interviews, the porridge that is in Washington these days makes it incredibly unclear as to what might happen. And the other thing is the government doesn't have 100% flexibility in all this, given that there's an act of parliament. Any changes to that act of parliament would be time consuming and would create lots of political issues. And there's about to be issued, or sometime to be issued, decision of the Federal Court of Appeal.
Okay, as you say, we're still just in the second period of this game, so we'll have to leave it there for now. Douglas Barrett, adjunct professor at York University Schulich School of Business. Really appreciate your time. Thank you.
My pleasure, and thanks for letting me comment on this.
Of course. Coming up next, first-time homebuyers are under pressure, but not everyone is being shut out. After the break, we'll dive into the surprising trend driving Gen Z homeownership and whether it's actually a good thing. Stay with us. Kevin Warsh has been sworn in as the new chair of the Federal Reserve. Warsh says he'll lead a reform-oriented Fed, adding goals will be pursued with resolve. U.S. President Donald Trump says America's future is unlimited with Warsh at the helm, and highlighted he wants Warsh to be completely independent. Some of the changes Warsh has promised for the central bank include shrinking its balance sheet and establishing a new framework for analyzing inflation. Slate Grocery REIT is considering a range of options. The Toronto-based real estate investment trust says it has formed a special committee to consider strategic alternatives after receiving an unsolicited takeover offer from its external manager. Slate operates U.S. grocery-anchored real estate. And shares of Zoom are rallying today. The video communications firm raised its annual sales and profit forecasts after reporting higher than expected quarterly revenue. Investors note the move signals customers are increasingly adopting Zoom's expanding suite of workplace software tools. The company has been working to diversify beyond video meetings by expanding into products like business phone systems and AI-powered workplace tools. And we're keeping a close eye on the TSX today. It is reaching March record highs as financials in particular advance today. We're seeing it up past 34,500 points at the moment. Continue to watch that one for you. And we're also watching the U.S. markets today. The S&P 500 on a bit of a record run this week, up by 0.7%. The Dow Jones up by a full percentage point, and the Nasdaq up by 0.7%, also driven by the tech sector today. First-time home buying is at its lowest level in decades, and yet new data shows single Gen Z women are entering the market at nearly double the rate of men in their generation. The numbers point to a growing gender gap in entry-level ownership, even as affordability pressures keep many young buyers on the sidelines. Here to break it down for us is Jessica Lautz, Deputy Chief Economist at the National Association of Realtors. It's great to have you join us. Thanks so much.
Thank you. I'm excited to be here talking about this.
Yeah, this is very interesting because first-time buyers, they're hitting a wall that's not been seen since 1981. We know that a lot of people are waiting on the sidelines. How are these single Gen Z women successfully securing financing on a single income in such a hostile environment at the moment?
Absolutely. So these women are savvy. They're moving home. They're living with their parents first, some of them. They do have higher incomes. So overall for Gen Z, we know that their buyers have an income that's a household of $76,000. We also know that they're taking advantage of government programs. So they're quite smart when they look at the housing market to see what they can qualify for and to even tap their 401k to make sure that they can secure a home of their own.
What's driving the gap, though? Like, why are men in this same cohort not doing the same things or not seeing the same results?
Well, I think what we know is when we look at the data that women have always outpaced men in the housing market. They're actually second only to married couples, and they have been historically all the way back to 1981 when we started collecting data on this. So I think women learn from generations of women before them. They learn from their mothers and their grandmothers to secure a home of their own, to earn housing equity. Marriage can come later, but let's get the house first.
You say also in your notes, I'm not sure if you mentioned this, that women, they're graduating from college at higher rates than men, giving them like an earlier career and income advantage even in their 20s.
Absolutely. They have a boost. And we suddenly saw for the first time in the 40 plus history of our data that single women, first time home buyers, their household income is higher than that of single men, first time home buyers. So we are seeing that college is paying off. So it makes sense that they're taking advantage of that earnings and putting that into the housing market.
What's the trade-off, though? Or is there a financial trade-off, whether that be like location, home type, or how they're saving for the down payment?
You know, I don't think there is a trade-off here. Of course, they are willing to make financial sacrifices. So they're cutting spending on other items like luxury goods or entertainment. But is that really a trade-off in the end? I don't think so, because they have a home of their own and they can earn that housing equity. You can always go out to brunch or host the brunch at your new place, right?
Do you feel as though younger buyers are prioritizing homeownership and financial independence earlier? Is that something you're seeing?
I think that Gen Z has really learned from millennials, and they understand how to make savvy financial decisions. So they're really second guessing that college expense, looking at that student loan debt, making sure the payoff is worth it, but they're also really saving. And so I think as we watch them transform this savings into the housing market, I think we could see a very interesting dynamic for this generation moving forward.
What's the difference there? Like, what were you seeing with millennials instead?
So for millennials, what we saw is many of them were partnered. So we did see that less than a quarter of millennials at the same age were actually singles in this market. And so these Gen Zers are saying it's okay to move into the housing market as a single buyer and perhaps looking at government programs, looking at their 401k as an opportunity to come into homeownership, more willing to move home, live with parents, skip paying rent. So they're making very smart financial steps for their future coming into homeownership.
At the same time, those Gen Z does make up a very small portion of the total home buyers at the moment, right? So what does that tell you about the broader accessibility of the market right now?
Well, I think when we look at the housing market overall for all first-time home buyers, regardless of age, it is very difficult to come into the housing market. If you have a household income under $75,000, you're going to have a hard time finding a home in the U.S. right now. So we do know that it's quite difficult to find that entry-level inventory.
And what does this trend tell you about where the housing market is headed, who gets left out if conditions don't improve in the long run?
Well, it continues to be a K-shaped economy. It continues to be a K-shaped housing market. We know that people who are homeowners build that housing wealth. They're able to transfer that housing wealth to the future generations. Those who are left out of the housing market are really struggling to really save for that down payment and be able to actually put all of that money together and then find that property too. So there is still a lot of competition when we look at the housing market today.
Does it seem optimistic, though, in the future in terms of more people getting into the housing market?
I think that there's a lot of pent up demand, and that pent up demand gives me optimism. When we think about the pipeline into homeownership, we need to have that available inventory for them to really enter into the market. We need to have lower mortgage interest rates, housing affordability improve some with more building. So if we see more inventory coming in, if we see affordability conditions continue to improve, we should see more home buyers there because that demand is certainly there.
And there needs to be more certainty too, right? Like what we've been hearing month after month is a lot of people still waiting on the sidelines because they're just not sure what's going to happen, particularly with the Canadian economy.
Well, I think that's probably true. When we look at uncertainty, we know this is the biggest financial decision that one makes in their lifetime. So they want to be secure in their personal finances, in their neighbors' finances. As they look forward, they want to have security in this financial transaction, certainly.
Okay, Jessica Louds, Deputy Chief Economist at National Association of Realtors. Appreciate your time. Thanks for joining us.
Thank you.
Coming up next is Hot Picks. We will zero in on 3 beverage stocks for your portfolio when we come back. Stay with us. It's time now for Hot Picks. We zeroed in on 3 plays in the beverage sector with Nick Modi, co-head of Global Consumer and Retail Research at RBC Capital Markets.
Non-alc beverages is growing faster than alc beverages right now. And then within beverages, you have energy drinks that are just, growing double digits. I mean, it's incredible what's been happening with that category over the last year. More importantly, it's been growing for 20, 30 years. And we think we're still in the very early innings of that growth curve.
Interesting. I wonder what's driving the energy drink curve and just also the alcohol side of things. You say it's not growing as quickly. It is still growing, though?
Not really. I mean, most of the segments in the market, the big segments, beer is down, wine and spirits are down. Obviously, you have ready-to-drink cocktails and prepackaged alcohol products are doing better. They're growing. That's really the only bright spot in terms of growth across the category.
Okay, so let's get into it then. Speaking of energy drinks, Monster Beverage Corporation is your first hot pick. Tell us how much opportunity you really see here.
Yeah, I mean, I see a lot of opportunity. I mean, we've had a buy on Monster for, over 15 years. And part of our thesis is we think this is just the next mega global brand, right? When you think about the global footprint of the company, especially as Coke is its biggest distributor. Coke has the most expansive distribution network out of any company on the planet. And then the category itself is growing. Now, here's an interesting statistic. Energy drinks in the U.S. are only 10% of the carbonated soft drink category, right? So it's still reasonably small relative to the grand scheme of the carbonated soft drink category. And the reason carbonated soft drinks are so big is because people consume those products with food. Well, now with all the flavor innovation, energy drinks are now starting to get normalized as something you can actually have with food versus it just being, I have to study or I have to do an overnight trip in a car, so let me take some energy drinks. People are actually starting to consume these products with food. And so I think we're still in the very, very, very early innings of the evolution of this category.
Interesting. All right. Primo Brands Corporation, that's the next one. That's your pick for today. Tell us why you like this one.
Yeah, Primo Brands. So basically, they are one of the biggest retail bottled water companies in the U.S., and they are by far the largest home and office water delivery business. Packaged water has been gaining share of overall beverages for the last 2 decades, and I don't think that's going to somehow reverse itself, right? And so we think we have a really cheap stock that has, I think, leverage to a very good category with good margin upside, and they're coming out of a little bit of a turnaround with a new CEO, and we think that's going incredibly well right now.
And last up, the Coca-Cola Company. Is there growth in this sector as well? I guess maybe like the non-sugar side of things?
Yeah, I mean, there's growth. I mean, Diet Coke is back on a growth trajectory. Coke Zero is growing really strongly. Even full sugar Coke is growing. I think Coke is obviously benefiting from a lot of market share gains as well. Now we have FIFA and the World Cup, which Coke is a sponsor of. That's going to be a big activation event for the summer, as well as America 250. So we think there's a lot of opportunity for Coke and its bottling partners to really engage consumers and really keep some of this growth momentum going.
What is the biggest headwind, I guess, for some of these companies? And they kind of are probably all, I'm assuming, dealing with different headwinds, just given the diversity of this sector.
Yeah, I would say at a high level, right? Obviously, macro pressures, right? Gas prices going up is not a good thing for any consumption. So I think that's something that the entire industry is dealing with. I think you have some changes in how SNAP funds can be used, right? The food stamps in the U.S. There's some certain states that are actually excluding some beverages from those programs. That could affect the overall category. And then obviously, like a lot has been made about GLP-1s. I do think it's a marginal impact. I just think the market might be overestimating the actual impact it's having. I think the bigger issue that's weighing on these companies right now is really macro-oriented.
Are higher prices and higher costs really affecting these companies at the moment too?
They are, but remember, a lot of these companies are hedged or have contracts that actually extend towards the end of this year. So a lot of the cost pressures that we might see in the market based on spot rates may not actually hit these companies until 2027. And the hope is that the economic environment normalizes, whereas they'll have a little bit more latitude to take price in 2027 to help offset some of the rising costs. What
about water as a beverage? Where does that fit into everything?
Yeah, I mean, look, water is like, if you're worried about GLP-1s, and like it's good to invest in a company that sells water. Again, like I said, for the last 20 years, or long as I've been covering this industry, which is over 20 years, packaged water has been gaining share of overall beverages. And I think that's going to continue, especially as, more and more science comes out that we as a nation globally are always dehydrated, right? We have like chronic dehydration issues. And then as the population ages, water becomes more important as well. So I feel like the water category is still in a really good spot. And what people might say, well, that's such a commoditized category, but guess what? The fastest growing segments of this category are actually the highest priced waters, right? And so I definitely think there's something here.
That was Nick Modi, co-head of Global Consumer and Retail Research at RBC Capital Markets. Coming up after the break, Albertans will soon get to vote on whether they will have a referendum on separation. We'll dig into those details next. Albertans will vote on whether the province should remain a party of Canada when they head to the polls this fall, a part of Canada, rather, when they head to the polls this fall. And we got more from CTV's Jeremy Sharon.
This is, significant in many ways. The province now will vote during a fall referendum on whether or not to stay in the province. Maybe not quite that far, because the wording in the question the Premier is putting forward is very important. Really, if you are in favor of separation, there are still two steps basically required to get there, not just one. That's because of the framing of this question the Premier put forward. I'll read you the exact framing. The question in the fall will be, should Alberta remain a province of Canada, or should the government of Alberta commence the legal process required under the Canadian Constitution to hold a binding provincial referendum on whether or not Alberta should separate from Canada? So really, it's the question before the question. That's exactly what separatist groups are frustrated about. The Stay Free Alberta group that put forward a petition that had 300 signatures proposing to put forward a question on Alberta separation. That, of course, eventually got thrown out by the courts because there was no consultation with First Nations. The group is highly critical of the Premier's address last night, calling it nauseating, or saying they are nauseated by it, and saying they are this is a cynical abuse of the people of Alberta, and raising questions about the Premier's future as a result of this. They're upset, Lindsay, that the Premier is not putting forward a simple yes or no question, but rather kind of adding a step, if you will, prior to a vote that would actually result in the separation process commencing. Nonetheless, we'll see a question added in this referendum in the fall, and that is significant in itself.
For sure. What implications are there for the rest of the country if a separation referendum were pushed to a ballot and then voted in favor to separate?
Yeah, I mean, look, I want to establish we're far from there, right? As I've touched on, there's kind of two steps still separating a potential vote on a decision that would allow for the province to separate if they were able to manage enough votes. Don't forget, there was a separate petition by a separate group called Forever Canadian that received 400,000 signatures. That petition was approved actually yesterday by Elections Alberta, just prior to the Premier's address to the province. So the implications would be significant, of course. It's hard to say exactly because we've never seen it in Canada. And so there would be negative implications. There would be all kinds of complex implications. This is a process that would take, likely years. But certainly it is one step closer to a possibility as a result of what we saw last night, which is the Premier adding a question around Alberta separation to the referendum in the fall. So a lot of questions still. I think the exact answer to what could this mean and what kind of implications could this have, Lindsay, are unclear still at this point. And I think many people just don't want to know what the implications could be and hope that we don't get to that point. And
Jeremy, just before we let you go, I take your point that this is far down the road, but it's interesting as Alberta pushes for this new pipeline, right? And looking for investors, if Alberta's looking for capital for a project like this, it's an interesting time to even bring up the idea of separation.
You raise an absolutely great point. The group pushing for separation is a group that is also pushing for a pipeline. Part of the frustration, part of the reasoning for wanting to separate is because of what they deem to be unfair treatment by the federal government for the people of Alberta who would like to see, the oil industry and the oil sands be more prosperous. And so at the same time, when you're looking to potentially build a pipeline and attract massive capital, you're not talking about a stable environment to invest capital in a province that is considering separation. So the two almost, are fighting each other in a way because the instability right now in the province is likely a deterrent for people looking to potentially invest in a massive infrastructure project like a pipeline project.
That was CTV's Jeremy Chiron. Okay, we're going to take a look at the markets before we wrap up here because we are watching the TSX closely. It is reaching some highs that we have not seen since, I believe, late March. You can see it's up by 0.4% at the moment. And we're watching some stocks within the TSX. BlackBerry, still the top gainer today on the TSX, as it was yesterday. No clear reason as to why. You can see BlackBerry at this point just spiking over the last day or so, up more than 19% at the moment. So we'll continue to watch that for you and see if any reasons pop up as to why the shares of BlackBerry are rising so much. Also, CAE, we were telling you about this earlier. Shares are dropping the most since 2022 today on lower expectations. This is despite CAE introducing a plan to increase operating income by 30%. And we know some investors there are expressing some concerns over the long-term outlook for CAE, citing limited contribution from organic growth. So you can see CAE down about 14% at the moment. If we take a look at U.S. markets, the S&P 500 is set for its longest rally since 2023 today, driven by tech stocks. You can see it's up by 0.6%, the Dow Jones 0.8%, the NASDAQ 0.5% at the moment. When we're looking at the S&P 500 in particular, though, and talking about tech stocks, Dell is leading the S&P today. It is up almost 17% right now. HP also up pretty significantly on the S&P 500, almost 15%. And then you've got Qualcomm rounding out the three, up more than 12%. That wraps up this edition of Trading Day. Thanks so much for watching.